Good afternoon, everyone. I'm going to talk about, is India ready for shareholder activism? What is activism? Right? It's essentially where a set of shareholders get together to effect change in a listed company. Right? What does it look like? Voting on shareholder resolutions. How many of you have actually attended an AGM or voted on a shareholder resolution? Nobody. How many of you own equity in a listed company? Right? Several of you. And this is really what we are talking about. So one is, what does shareholder activism look like? Just look at what it essentially means. One is voting on shareholder resolutions. So what happens is, regulations requires companies to seek approval from shareholders for a certain set of agenda items, right? This could be appointment of an auditor, appointment of board of directors, mergers and acquisitions, executive compensation, borrowings. So a lot of these agenda items require shareholder approval. You as shareholders have actually a right to vote on all these resolutions, right? The second is engagement with companies. Today, retail shareholders tend to engage with companies through the AGM mechanism. You attend an AGM, you ask questions of the management, and that's how you engage with management. Institutional investors, which are your mutual funds, insurance companies, pension funds, EIFs, have the ability to have one-on-one meetings with management. They attend investor calls, and therefore their engagement levels with companies are different. So what happens in these conversations? They're able to meet the management, address all the concerns that they have as far as the corporate behavior is concerned. Then you get to the more serious pieces, right? Where you say shareholders can get together and actually propose a resolution, ask for an extraordinary general meeting, and regulations say that essentially 100 shareholders need to get together, or you need to own more than 10% of equity, and you can actually propose a shareholder resolution, which means you can appoint a director to the board, and some of these other things, and seek an extraordinary general meeting. And of course, the most aggressive version is taking the company to courts, filing for winding up, or taking the company to NCLT for a whole set of reasons. What happens with this activism? What is the outcome, right? Possible outcome, look at board changes. Certain board members are not reappointed to the board, or they're not appointed in the first place to the board. You can affect management change if you fundamentally believe that the management is not performing well, not protecting your investment. Then yes, you can affect management change by voting. You can also look at stopping or agreeing to takeovers, mergers, which essentially allows you that much control over the destiny of the company. Right? Now, which of the companies which have seen, and this is again an indicative list, not an exhaustive one, but these are some of the companies which have already seen a degree of shareholder activism, right? In Fortis, actually, is one of the most successful stories where two sets of global investors got together. They hold more than 12% equity. They got the board removed, got a set of independent directors who found a strategic partner for the company, right? Z and Desh are extremely litigious right now. Religare and ICICI Securities are currently facing the activism where they have a pushback from a set of shareholders. So you see that there are enough number of companies, even PSUs are not sort of away from this, right? In PTC, for example, investors try to get a board member onto the board because they felt they could unlock more value. And these are sort of elements that you see happening. So India is currently, a lot of corporate India is witnessing some form of shareholder activism as of right now, right? And again, like I said, this is an indicative list, not an exhaustive list. So, three changes which are empowering shareholders today, and why is all this activism happening? Fundamentally, there's an increasing institutionalization of shareholding. Second, there is a regulatory push that empowers shareholders. And third is the advent of proxy advisors. And we just go into the details of each of these, right? So if you look at this slide, you find that promoters today own, that is controlling family, right? The nature of Indian markets is different from what you would see in the West, where you see that 2/3 of corporate India is controlled by controlling families. They're called promoters. They founded the business over a period and listed them, but they still own dominant equity. What is happening now, while they continue to own 50% or more on an average for the Nifty 500, and let me remind you, Nifty 500 accounts for roughly about 92 to 95% of total market capitalization. So while promoters own about 50 to 50% of the equity, their equity is actually coming down, right? And that's also because companies are growing, promoters are also getting diluted as they raise capital, and some of the promoters are actually selling down the equity. What's also happening in as far as the generation is concerned is you are now changing from the first and second generation of ownership to the second and third generation of the ownership. So there are from siblings you're now coming to cousins, right? And therefore there is a difference in the way the equity is being looked at by sets of by factions within the promoter group. So increasingly we are seeing more promoter disputes also happen, as a result of which you're now seeing that there is greater so the amount of control that promoters have is at softly sort of decreasing. At the other end, what is happening is institutionalization of the shareholding. So you can see that institutional shareholding is increasing. Also, what is happening is a new set of companies which have no promoters. So if you look at the sort of disruptive businesses which have come in and now gotten listed, they essentially were supported by private equity. The founders have very little equity, and once they actually got listed, they are considered promoter-led because the founders also with let's say 7 or 10% equity not considered to be in control. So as these companies get listed, the private equity exits. You will find that these will become institutionally owned companies, and therefore the ability of shareholders, institutional as well as retail shareholders, to effect change sort of increase. And you can see this graph which talks about the number of promoter-less companies now, which is increasing in the Nifty 500 index. Right? Sorry. Okay. Second is the regulation. Regulatory changes have been very interesting in the recent years, and I think 2014 to 2022 is a real cusp. So if you look at the corporate governance reform, they started with voluntary adoption of good governance practices. Over a period of time after the Satyam fiasco, it became mandatory. What is happening now with the new Companies Act of 2013 and the new listing regulations is shareholders are getting empowered, right? You as shareholders now have greater say in how companies will behave, for the fact that several changes have happened. One is just regulations are now addressing a simple issue of management of conflict of interest. So let's say a controlling family there's a listed company, they own 52 or 55% equity in that company. They also own 100% of the distributor, right? So essentially there is operating control, or they own 100% of the supplier. So there is again a supply control. And therefore, when the transaction happens to buy from the promoter controlled entity or sell through the distributor, it now needs a majority of the minority shareholders to vote. So promoters really can't vote on that transaction. The rest of you will actually vote on that transaction to see whether it's kosher or not. And that empowers shareholders significantly. The other is the stewardship codes which have come in, and these have had a very material impact on the level of engagement between companies and shareholders, right? Let me just quickly explain what is stewardship. So a steward is essentially someone who takes care of the assets when you're not around. It's a simple sort of context, right? So now you and I put money in a mutual fund. They are essentially the caretakers of our money, right? And therefore they have a fiduciary responsibility to ensure that the money is deployed well in a responsible manner, and therefore the companies that they invest in also behave responsibly, right? And therefore, the stewardship code essentially is now mandatory for all sorts of asset managers. And there are two broad elements to it. One is, yes, voting on all the shareholder resolutions, and the other one is engaging with companies. So, the history of stewardship, I think SEBI was the first one to start off the vote and trying to tell mutual funds they need to have a voting policy and vote on shareholder resolutions. The big kicker came in 2014 when voting moved from show of hands to e-voting, right? So today, if I held 1% of the company and if I had a show of hand, it would be counted as one vote. But if I held 1% of the company now and when I vote on e-voting, 1% of the capital actually gets voted upon, and that's the weight that it actually carries. And that's a shift. I know in the age of generative AI, this sounds very, very basic, but this is a very material shift and made a material change to the dynamics of the relationship between the investors and the promoters. So over a period of time, while SEBI started with pushing mutual funds to vote, the insurance regulator in 2017 therefore asked insurance companies to have a stewardship code, and slowly it moved to the pension funds, and again SEBI came back with a stewardship code for mutual funds and AIFs. and made it even tighter in 2021, saying they have to vote for or against. You can't abstain from voting on any shareholder resolution. So you can't take a position which is sort of passive. You have to take a yes or a no kind of a position, right? The third is the advent of proxy advisors, and I work at a proxy advisory firm. Essentially, proxy advisors are focused on corporate governance research. The fundamental idea is to ensure that rights of minority shareholders are balanced against those of controlling shareholders. So there is equitable treatment of all shareholders, and therefore, to that extent, they're protecting the rights of non-controlling shareholders. How do they do that? Now, we've talked about the fact that mutual funds, insurance companies, pension funds all need to vote on shareholder resolution, right? So, proxy advisors provide research on how these asset managers should vote on the resolutions, with the view that it protects the ultimate shareholder, which is the retail shareholder, right? So proxy advisors provide voting recommendation shareholder resolution. They also do a lot of advocacy on corporate governance. So their advent has actually brought this debate front and center. There are 4 of them registered with SEBI right now, and SEBI becomes the regulator for proxy advisors as well. Primary customers are, of course, institutional investors. But you see the degree of pushback that proxy advisors have been able to bring, right? This is just print media. There is, of course, digital media that you will see. A lot of pushback that proxy advisors have brought in is also pushed companies to look at themselves a little bit more clearly. And they're a lot more now sensitive to how investors are voting, what proxy advisors are saying. And therefore, by and large, that's helped sort of empower shareholders and also improve governance standards in the country. So what is the impact of all of this? More and more shareholder resolutions are getting defeated, right? Directors are not getting appointed, executive remuneration levels are getting defeated, transactions are getting defeated. So you're seeing an increasing number of resolutions getting defeated. More importantly, more than 70% of the total capital is voted upon. The piece is retail shareholders like you are not voting, and that will change the game dramatically if you do. The percentage of voting outcome for retail shareholders is very low. The percentage of voting outcome for institutional shareholding is almost 90%. And you are seeing increasing investor pushback, right? And this is a slightly sort of difficult slide, but this is a slide which tells you that institutional investors are pushing back on a lot of the shareholder resolutions. So they started off tentatively while more or less supporting what management said, but now they're taking a much more discerning view on how these resolutions actually impact the unit holders finally at the end of it all, right? At the end of the day, you ask what therefore changes, what should change for shareholder activism to become much more vibrant, right? So I think there are 3 things that we think will change it even more than it is. And let's be fair that you're seeing activism even today. But if you have to see it in the global context of how aggressive it is, or how much pushback you can actually give companies, there are 3 things which actually need to happen. One is, of course, efficiency of the judicial system, just faster, court turnaround of cases being faster. The other is success fee based litigation. So if you look at the US markets, for example, lawyers will take on a class action largely because they get a share of the final pie if they win. In India, this is not allowed. So while class action suits are notified and you can actually have a class action, you need to therefore be able to pay the legal bills and stay the long ball before you can actually see an outcome. So that we believe will, having success fee based litigation will change it for class action suits. Second is clearer regulations, not more regulations and not prescriptive regulations, but just clearer regulations. Just a better clear definition of, just simple things like what is control. That itself, is a bit more ambiguous than you would actually think as far as the legal term. And greater sophistication of investors. Investors taking stronger positions on issues, they are certainly becoming more vocal, but there is still room to grow. Better collaboration between investors. I think institutional investors today can together, sort of bring greater change than doing it individually. But I think they get caught in this whole persons acting in concert and the legal pieces around it. But better collaboration between investors will certainly make a greater impact. And more retail participation. You all vote for the central government, you vote for the state government, vote your shareholding on shareholder proposals. You have a right to. Yeah, so on that note, thank you very much.